Frank has asked a question about, what are we actually trying to do in this global equity strategy and how are we managing the money? He touched on two objectives. The objectives are very important to us. The first objective is a preservation of capital objective that we have. What we mean by that objective, for you to clearly understand what we're trying to do, is we are trying to get a lot of protection on the downside in adverse market conditions in the strategy. So if markets are down 20, I would have an internal objective with the investment team of sort of being down sort of 10. We're absolute return, we've got the pulse of the market through our strategy. So we're not hedging out market risk, we're a long-only strategy. But we are looking to get a serious amount of our excess performance in down market conditions. Why is this important to us? It isn't just to try and make you and your clients feel better in those market conditions. We genuinely believe that if we can take out a meaningful part of that down cycle, through the entire cycle, returns to your clients will be materially enhanced. And there are a lot of studies that have been done on this topic. One I read about a year ago was a study of the S&P 500 that said that if you had not invested in the 20% worst performers over the last decade, the returns you would have generated from the S&P would have been 10 percentage points better per annum than the S&P 500 delivered. So avoiding the downside is very important. Of course, it's impossible to go to a manager and just say, please buy me everything other than the things that don't do so well. So it's hard to do, and we're doing some very particular things that I will talk about. The second part of our strategy is actually return objective. We have now, I think, $114 million of our own money between the company and the principals of the firm invested directly in these strategies that we're managing. And we have set a return objective after fees of a minimum of 9% per annum through the economic cycle. That isn't 9% every year because, of course, markets go up and down, but through the economic cycle, we are aimed at generating an acceptable return on the capital that we're entrusted with. We simply don't care what the indices do. If the indices go backwards in the next 5 years, we still have an objective of 9% per annum. So we will never come to you, and we're not guaranteeing by any stretch of the imagination we can deliver that. We obviously feel pretty confident that that is an achievable objective, but we're not guaranteeing it. If we don't achieve it, we will come to you, and I will personally come to you and tell you why we got it wrong. We won't come and make excuses that there was a financial crisis in Europe, or there was a war in the Middle East, or China slowed down, or whatever the events may be. We will not make excuses for those things. We will tell you why we got it wrong. I think it's as credible, and I've written in the investor letter, and some people have probably read it. I think that what's happened in the last 5 years, people totally blaming it on the markets, is as credible as saying the dog ate my homework. At the end of the day, that is what our job is at the end of the day. And I would say there has been nothing that has happened in the last 5 years, and there is nothing that is happening currently that is unpredictable. There are some things in investing life that are unpredictable, but none of them have actually happened in the last 5 years. Most of the big events that have affected markets have actually happened over a number of years. Lehman Brothers collapsed in September 2008. The subprime crisis started in August 2006. You actually had 2 years to think about this event. This European issue that we're all grappling with really started in about March 2010. That was over 2 years ago. If you haven't had time to think about this at the moment, if you're managing money and pretty much work out what the probabilities of things happening, there are things in the world that happen that are entirely unpredictable. And then it comes down to risk management of how we will protect people on the downside. And maybe, Frank, I'll give people just one bit of insight, given we've got such an intimate gathering of Frank's friends here. I normally wouldn't probably give this amount of insight to people, but I think in the spirit of transparency, I think I deserve to give that to you today. What we do in managing this global equity portfolio that a lot of people are not aware of, and I regard it with some sensitivity, we actually manage the portfolio as two different portfolios in the one strategy. The core portfolio that sits there is what we call our long cycle portfolio that happens to be a very low volatility portfolio. It has a very low, something known as beta, relative volatility to the market. It has a very high quality score that we rank internally as part of our research, and we're trying to optimise that portfolio to give us a return at least 10% per annum with the lowest possible volatility we can get. This is where a lot of our consumer names that you're very well aware of, like the Yum brands and the Coca-Colas and McDonald's and Procter & Gamble's, Nestle, etc., have sat in the portfolio. I think there is a confusion amongst our competitors, which entertains me, of why we own some of those stocks. And to be frank, some of those stocks have become a little bit more expensive, Frank, in the last while, but we have switched out the more expensive ones with other what we call long cycle names that aren't subject to much macroeconomic risk. So we have sold down names like Yum brands and we've bought names like Walmart. They give us a buffering in terms of the economic scenario. The second portfolio we run inside the strategy is what we call our short cycle portfolio. This is a portfolio that is much more subject to change risk, to macroeconomic risk and views, to technology risk, to financial leverage risk, to interest rate risk. This is where our financials fit in. We've got Dom Giuliano here who runs the financial team. Thank you, Dom. Dom has done an outstanding job for investors over this period. This is where our tech space fits in. This is where our consumer discretionary stocks fit in, and because it is much more subject to what the economies will be doing, what technology will be doing, it's actually an area where a lot more skill has to get applied in order to create real alpha or excess returns from the portfolio. And if people had the information, about 80% of our excess returns have come out of that part of the portfolio, and we combine these two portfolios together with very, very clearly defined risk metrics that we run that gives us a lot of confidence that we have a high probability of getting excess returns when markets turn down, and we're very, very focused on managing it, trying to achieve our minimum 9% per annum through the cycle. So I would hope that's some background and setting. We are just not owning consumer names because they're in emerging markets, and I know we've spoken to you about that. We're owning them because it's giving us a very particular risk characteristic in the fund, and when they turn out to be more expensive, we will swap them out for other similar risk quality aspects that will give us a similar profile that we like.
Because I know, Hamish, even conversations that we've had with some advisors walking in saying, well, great 12 months, Hamish, how do you keep it up? Is the portfolio fully valued? Have the stocks run too hard? So hopefully that kind of puts that to rest to some extent. I feel like an auctioneer now because I'm going to open up to the floor. We're happy to talk about macro, we're happy to talk about politics, we're happy to talk domestic, we're happy to talk about what's going on in the world, and God only knows there's lots, even though the Olympics have finished. Who's going to open up with the first question? There you go, where's Mark? And Jack, middle of the room. Thanks, Burjo.
Nice, soft, easy one to start us off.
Let's see.
Is that on? Hello,
Yep.
yes. Greg Middleton from Centric Wealth. Hamish, short cycle, long cycle. With the long cycle, I can imagine that's more sitting at your desk here in Sydney doing the analysis. The short cycle, how much more dependent is that on looking the management team in the eye and getting a feel of the changes that are happening?
It's a wonderful observation. Obviously, with their more moving parts, you have to do an enormous amount of analysis, both macroly and at the individual stock level, to understand where the investment case is is headed. We spend, and the investment team spends an enormous amount of time with management of these companies, actually both in our long cycle and our short cycle. It's critically more important in a financial than it is in a Coca-Cola. But I, once a year, will go and have a lunch in the boardroom at Coca-Cola once a year, and we will frequently, Nikki Thomas, who runs our consumer team, has a great relationship with the Yum management team, and we have seen them all around the world, and she just spent half a day with David Novak, who's the chairman and chief executive, a few weeks ago, maybe 6 weeks ago, when we were both in the States. But at the level of a financial, for instance, we've got a very large investment in Wells Fargo, a very large investment in eBay. Wells Fargo is now the second largest bank in the world, and I would spend probably twice a year. I would spend 1 to 2 hours with John Stumpf, who's the chairman and chief executive of Wells Fargo, on a one-on-one basis, as Dom Giuliano, who's sitting on the table behind you, would spend time as well. So we spend a lot of time travelling. We are really interacting at the senior levels of these organisations, and for some reason we've managed to get terrific access. And these companies really value having investors from Australia.
Hi Hamish, you said that you were targeting the 9% over the economic cycle. In your head, how are you deciding when that cycle or that time frame looks like?
Yeah, we frame the cycle at 5 to 7 years in terms of a full economic and market cycle. So we're probably into a 7 year cycle. Obviously, we have to make a judgment where we are in those cycles from a macro point of view, because we then position the portfolio depending on our view where we're up to in the cycle. I'm sure we'll get some good questions today around where we may be up into certain cycles and what our view on different parts of the world economy is and how we're positioned for that. But 5 to 7 years, and then we have to judge where we are in that cycle.
Hi Hamish, Peter Richards here also from Centric. Just a quick question. Obviously you've protected the portfolio incredibly well in the last 5 years with rough markets. If I was being devil's advocate, and I'm not, but if I was, obviously the market might go up one day. How well positioned are you to participate in that upswing?
Yeah, I think that's a very good question. We're aiming at the return through the cycle. There are absolutely going to be market conditions. I'll give people one more piece of information here. Please don't go and tell all our competitors. We actually run the strategy, we cap the beta in the strategy at 0.8. So we're running a strategy with inherently lower volatility than the market. That's very important to us given what our objectives are. When a market is in a bull market phase, I doubt that's going to happen for some time at the moment, but when it's in a bull market phase, it is very, very likely when valuations are more stretched that we will underperform that phase of the market. That's when small caps, emerging markets, commodities and other sort of strategies that you may well have in the portfolio should be doing pretty well in that part of the portfolio. So there are very distinct periods in which our style will underperform a benchmark. They tend to be in pretty strong markets, so we're still going to probably be delivering nice returns in that part, but we will never put the risk on to try and outperform that. In markets like we are at the moment, where markets have been rallying in the last while, and we've had various iterations, we've had big downs and we've had rallies, virtually in every period other than one short period in the last 5 years where there was a market rally, our short cycle portfolio has delivered enough performance for the whole portfolio to outperform every market rally we've had, bar one where energy rallied very strongly. So in market conditions, if the markets went up 15% from where we are at the moment, or 20%, those aren't market conditions that worry us very much.
Where's Jack? Oh, sorry, at the back. Yeah.
Tony Adams with Dataway Financial. 5 years ago when you launched the funds, I remember you saying with regard to the focus of the portfolio being through the Procters & Gamble's and Yum brands into the Asian growth, and especially the rollout of KFC and the Pizza Huts and so forth, and the healthcare products in Asia. But looking at your portfolio today, you don't actually appear to have such a focus in the sort of the China rollout, so to speak. Is that still the case, or am I missing something?
Yeah, I think you're making a very good observation. That space of those consumer stocks, which we've had a fabulous position for 5 years, there's been a lot of money that's gone into defensive consumer stocks in the last 6 months or so, and that space has become more expensive. We still hold a reasonable proportion of the fund, probably about 28% of the fund in those type of stocks, but it was probably 38% of the fund in those named stocks. Danone is probably the only stock in the top 10 on this list at June that you would see, where typically we would have had Coca-Cola, Yum Brands, McDonald's, Procter & Gamble, Nestle, you name it, would have been very prominent in our top 10. Many of them are still in the portfolio, which is 24 stocks, but they are less weighted to the portfolio as valuations have changed. We're not owning those stocks because we want them to be easy stories for people to have. We're owning those stocks because we want to make money for your clients at the end of the day. And if you take Yum Brands, and Nikki Thomas is here, and if you go out of this room on the way out, she's one person you should thank a lot if you've been invested in this fund. Yum Brands was bought into this fund and it's out of the top 10. It's actually back in the top 10 today, but you can't see it because this was at June. It was bought in July 2007. This is the KFC business that has a very large China business. We bought it, I think, at between $28 and $30 a share, and we sold it down in May at about $74 a share after 5 years of ownership, and the markets went backwards in that period because we bought it just before the market peaked. Just an incredible story. We sold it down on the back that we thought it was getting more fully valued, and we were concerned about a slowdown in China. And then the price fell and it got back in a zone that we kind of liked it, and we bought a bit more of it back. But still, the fundamental themes behind those consumer stocks are still very strong. They're still there, but we now have got investments in Novartis and Tesco and Walmart and a few others that have just been a better value trade at the moment. But values change all the time. It's still a very attractive space to go fishing in. It's just less attractive than it was from a return point of view.
Over there.
Robert Dunn, H&W Planning. Hamish, in previous presentations, you've given a wonderful overview of your outlook for the world going forward. I've got a lot out of that. I'm sure others have. Hopefully you're set up to do that this time as well.
Absolutely. You need to fire me a question. What would you like to know about the world? That's a very broad question, the whole world. Could we just narrow it down a little bit? Is it Europe? Is it China? What would be the thing? I'm sure we can get a few questions here from...
Well, I guess your stock tends to be concentrated directly in the US and indirectly into the emerging markets. So the ones where you've got stock exposure.
Yeah. We are overweight the United States, both the dollar and in terms of short cycle economic exposure. We are really predominantly overweight the US. In our long cycle or lower volatility portfolio, we're pretty much spread around the world and overweight emerging markets in that part of it. So why would we be overweight the United States at this point in time? It's our view that the US is going through a very modest economic recovery at the moment. It is effectively dealt with quite early on the capitalisation of its banking system and the realisation of losses through the system. And it's our view that the next leg of driver in the US, we've obviously got some short-term issues with the US elections and uncertainty with Europe, but if we take a 2 or 3 year view, we have a pretty strong conviction that housing construction is coming back in the United States, and it's an incredibly important driver of the US. Currently, the US is is spending slightly over 2.3% of its GDP or national income on private fixed residential expenditure. It has averaged over 60 years 4.7%, and of course before 2007 it was actually between 6 and 7%. And you may not think that expenditure between 2.3 and 4.7% is much different, but if I told you it's between 4 and 500 billion US dollars a year of additional investment into housing stock. What happened pre-07 was that the US was constructing each and every year over 2 million houses a year based on population growth of about 2.5 million people in the US and natural rates of deletion of housing stock. We believe that the US needs to construct on average over time about 1.3 to 1.4 million houses. In the depths of the recession, it was at 400,000 houses. It's currently around 700,000. It's ticked up. Housing's actually ticked up in the last few months. So it's still running at half capacity in the United States. We think there is still another 2 or 3 years of excess supply that has to get worked through. And when it does, housing construction demand is going to have to come back in. We're not predicting house prices. This is all about demand, and that will inject, with a multiplier effect, maybe 3 to 4 percentage points of GDP in the United States, and at that point we'll start to get an acceleration. We'll have a whole series of interesting implications for the world, including on interest rates and monetary policy around the world, and we are overweight our short cycle on a US 3-year view based off housing. We own Lowe's and we own Home Depot, two very large home improvement retailers, the Bunnings equivalent of the United States. Home Depot reported the night before last 17% earnings per share growth, 22% for the whole year so far. They're drowning in cash flow. They're very leveraged to this. Lowe's is a similar story. We own some US banks. So in terms of the big part in our portfolio that's sensitive to the macroeconomic side of things, we are very overweight a United States view. We're also overweight the US dollar. One, it gives us mitigations if there is a serious event in Europe. We actually think it's a very low probability of getting a serious event in Europe, but if there is one, being overweight the US currency will help mitigate things. We also think the US dollar relative to the Australian dollar is a very good play to be in with a 3-year view in mind. The rest is pretty much spread around the world in terms of that. We're still overweight emerging markets. We are probably more cautious in the shorter term on emerging markets. China's certainly slowing. Brazil has slowed dramatically. India's slowed dramatically. But this is just part of their cycles. The long-term story for emerging markets is still completely intact in our view. We've got a few here.
Hamish, another world question, but given your prior fund manager expertise, if you can give us an update around Europe, if you have any comments about whether the sovereigns or the banks are the biggest trouble, or where the potential biggest trouble is, and if the imbalances with Target 2 keep going, just where that's going to send us.
Sorry, could I just get the last part of the question?
The Target 2 imbalances.
Yeah. Let's start on the first high-level proposition in Europe. We think that the probability of having a total financial meltdown scenario, most likely triggered by a sovereign default, which would then trigger a series of banking defaults in Europe, we think the chance of that probability playing out is incredibly remote in playing out. And I'll explain why we have that view. We also believe that it's going to take a number of years before we get a sensible policy setting that says the euro survives, which we believe it will, but we're not going to get clarity on that for another few years, which means we're going to have market conditions and some volatile periods probably for another few years on the back of Europe. Why do we think it's highly likely that there's a low probability of getting an Armageddon risk in Europe? And why do we think it's likely that the euro will ultimately survive this chapter, most people will know that the Euro project is fundamentally flawed. It's a statement of fact. You have a monetary union with no fiscal union. But just because something is flawed doesn't mean it will fall apart. It is very, very difficult to pull this project apart. It's kind of prisoner's dilemma that they have in Europe. If you look at the total structure of Europe, if you look at, very importantly, their current account, the current account balance in Europe is actually in balance, which means Europe is not actually dependent upon the goodwill of foreign nations outside the monetary union to support Europe. What has been happening, which comes to target two balances here on the individual central banks' balance sheets in Europe, the surplus countries of the north, being Germany and Denmark and others, have been running large trade and current account surpluses. That delivers excess savings of the nations. They have been investing those excess savings largely in southern Europe, who are running deficits, which of course need to fund those deficits from foreigners. Those foreigners have largely been other Europeans, but the total Europe's actually in balance, which is good news if you think about the survival of Europe. Of course, what's happened is southern Europe has hit, after a very long period of economic mismanagement and running large budget and current account deficits, has hit an absolute crisis of confidence. So money from the north has been withdrawn from the south, and we've had a sovereign bond crisis and banking crisis in southern Europe. And what's happened is bond yields in the north at the short duration have gone negative, because people are trying to shove all this money back into Germany and other places, and there literally isn't enough things to buy. That has created very big dislocations in sovereign bond market and credit markets at the moment. So what is the game that's being played out? The big fear in Europe is that a larger nation like Spain, which is the fourth largest economy in Europe, the fear is that Spain gets locked out of the capital markets and would have to turn to get bailed out by the European Union. And if you look at the next 3-year funding requirement, or 3.5 years, the remainder of this year and the next 3 years, the total budget deficits and the total maturing both federal and state or local debt of Spain comes to approximately 550 billion euros. And the banking system probably needs, which is part of your question, needs at least another 100 billion of capital injected. So that's 650 billion for Spain. The European Stability Mechanism, which is the new bailout facility that came into force, subject to a German constitutional challenge on the 1st of July, came into force. It has total firepower of 500 billion. So if Spain really needs a bailout, is it beyond the capacity of the bailout mechanisms to bail out Spain? And if Spain's in trouble, what about Portugal? What about Italy? And a country people don't mention, which they should, what about Belgium? So if you add all them up, a total bailout of Europe appears to be beyond the capacity of the European nations to deal with. And given bond yields are going up, and given that no one seems to have a total policy answer to this, isn't that a high risk event? And we would say to you is all those facts are good observations by people. But the reality is, if we get to the point of no return where Spain can't be funded, we feel very confident that the European Central Bank will print money in an unlimited fashion to effectively monetise the government debt of these countries. And the reason we have confidence in that is when the banking system got in a dangerous liquidity squeeze in Europe at the end of last year, what happened was the ECB printed in December and February this year, I think most of you will know, €1 trillion of fresh money that banks could borrow on an unlimited basis at 1% interest rate for 3 years. And we think that if you're in this position of potential financial Armageddon, where a country like Spain couldn't fund itself through a crisis of confidence, the European Central Bank will step in, and there's a number of the ways they can do this, and a number of them are being debated, which I could go into if people are interested, but there are a number of ways to do it within the bounds of the Maastricht Treaty. And then someone would rightly say, but the Germans seem to be opposed to this. And I would say, of course the Germans are opposed to this at the moment, because the only way Europe has a hope of long-term survival is through closer integration and microeconomic reform in southern Europe, both a banking integration and through microeconomic reform, particularly labour market and other microeconomic reforms in southern Europe, and a devaluation of the euro to effectively fix up part of their current account problems that they have. If the magic bullet is the ECB prints, why don't the Germans allow that to happen at the moment? The Germans know that southern Europe will never ever reform if they're given a get out of jail free card at the moment, and therefore the Germans have decided to keep markets close to a state of panic and to keep their foot on the jugular of these nations to force through reform. If it turns out that time defeats the Germans, they will allow the ECB to print money. So that's our view of the topic. We think it's relatively low risk. We think the markets are relatively low risk at the moment, although there will be some events almost assured in the next 6 to 12 months where Greece gets to another point where it's not complying with its obligations. The markets will again get nervous. Markets will be volatile. Again, we're going to have some problems in Spain. This is a very difficult and complex problem, and therefore we're going to get more volatility in the next 12 months. Volatility doesn't worry us. I think you should also expect volatility, but the probabilities of getting an Armageddon event in Europe are low. But we've got another few years of these coming out, and people talk about the Germans don't know what they're doing. The Germans know precisely what they're doing in our view, and there's not a lot of options available to a very complex problem.
A bit of a double-barrel question. I might shoot twice if that's all right. The first one is, can you just comment on the relevance and the likely short, medium and longer term impact of the fiscal cliff, so-called, in the United States, and whether that's going to be another air pocket in the markets, or we're just going to breeze straight through it, or is it going to be like the debacle that it was with the debt ceiling last year?
Okay, I'll start on that. In the fiscal cliff in the United States, I think most people will know what was done last time they had the debt ceiling debate. They put in some automatic cuts that have to come in the event that Congress can't agree a new plan going forward that theoretically could have a 5% contraction on the US economy at the beginning of next year. We've obviously got a US presidential election in November, which is in between this period. We think there is a very low probability of a significant contraction from a fiscal point of view at the beginning of next year. There will be some, but of significance we're not overly concerned about it. If you look between Obama and Romney, and I know Paul Ryan's now got in the mix, really there's not fundamental differences from a fiscal point of view. Obama is a Keynesian who wants to spend money at the end of the day. Romney is a person who will want the Bush tax cuts to stay. The Bush tax cuts, if they stay, is effectively a stimulatory measure in the economy and won't lead to a fiscal cliff. Obama actually wants to spend money. He wants to get rid of part of the Bush tax cuts and obviously not have as dramatic expenditure cuts. We may get a period at the end of this year post the election where markets get jittery depending on how the final fall of Congress and the Senate sits. The probability of not getting through that and having a major contraction next year, I think, is relatively remote, given both sides who are running for the White House.
Thank you. The second part is, I think you captured the politics of Europe well, especially in relation to what Germany's doing at the moment. We've got deflationary pressures there. Japan's been described as a bug in search of a windshield. The US is still trending in that direction, even though in the short term they have a lot more positive signs in their economy, but their long-term position is probably deteriorating as well. If money printing is the end game, which I think has probably been the conclusion now for some time, when that tidal wave of printing gets converted into inflationary forces and then that hits the global bond markets that we have at the moment that have all these ridiculous government manipulated yields in them, that's looking like a pretty scary scenario. You love coming across very sanguine and calm and relaxed. I think they're words that you use a lot in your telecast. Are you relaxed, calm and sanguine about that tidal wave of inflation hitting those bond markets?
I must admit I don't quite see it exactly the same way you've outlined it. I do believe that inflation is coming to Australia, and I do believe inflation is coming to the United States. I actually don't think inflation is coming to the US because of a monetary printing issue. I think inflation is coming to the United States for a fundamental factor that they're going to start to get a lot of imported price inflation into their economy, and they're going to have an expansion of their economy at the same time, and they've got a massive amount of money that's been printed that the Fed is going to have to sterilise unless they want a very high inflationary outcome. And the Fed will sterilise that in the period. As it starts to recover, people will be more and more concerned about how the Fed's going to do that. And if it has to obviously sell bonds back into the market, it's going to dramatically push up bond yields in the United States off the back of that. And as the economy starts to recover and if inflation starts to come, they're going to have to be pushing up the cash rate materially. It could cause a one almighty correction in certain asset classes around the world when that happens. I think it's highly likely that that scenario is going to play out, not for the monetary printing reason that you've espoused, but for other reasons. I think you get to a similar conclusion. We're not worried about that because we're going to profit from that very materially, because we've already set ourselves through the way we've owned some banking financials that should make a lot of money in that environment of how their balance sheets are structured, and the yield curve will change. But you wouldn't want to be long duration credit. You wouldn't want to be in the wrong currencies. Because when this happens, it's going to, and it'll be led by the United States because it's the first piece that's going to move in this puzzle. When it gets led by the US, the whole world credit environment will change. Europe itself doesn't have the same inflationary pressures in the immediate term. It's much more deflationary because they're probably a 5 to 7 year recession. Australia is a very interesting equation when you think about it, is what's going to happen, we believe, in the next 3 years. The exchange rate when the Fed moves in the US will dramatically change course as bond markets change. And when the exchange rate comes down, the price of imported goods go up materially. You could argue that's one-off, but the problem is we're importing goods from countries that are highly inflationary now in terms of their labour wage rates, like China. And therefore we're going to be having a natural imported price inflation into this country. When the exchange rate adjusts, we think the commodity peak's happening. Hasn't quite happened, but will happen by 2015. When that happens, you'd expect the exchange rate will be the offsetting mitigation for our other export industries and our resources sector. I just don't know what our other export industries are anymore in this country, unfortunately. And therefore, we're going to be facing a dilemma where our economy is going to be slowing down and inflation's going to be going up. It's a big, big dilemma for the Reserve Bank to deal with. It's going to be very interesting how long they argue this is transitory when it happens. So is inflation something we're concerned about? From a US and an Australian point of view, yes, we're worried about it. From an emerging markets point of view, particularly food inflation, we're worried about that, food and wages inflation. Europe, we're less worried about, and your description of Japan is very apt.
We're hearing a lot of talk about a lot of cash being held, I guess, on US corporate balance sheets at the moment, and also very accommodative borrowing rates for them. When you guys are talking to company management, how is the volatility in markets and the risk of policy actions, I guess, impacting their strategy? And as Soares puts it, what's the risk that their, I guess, defensive approach to the economy going forward is going to cause some sort of self-reflexive impact on it and slow things down, no new hiring, no acquisitions?
Yeah, I don't think it's having a huge impact on people's decision. I think, if anything, what is driving people's investment decision, I think there's a little bit about the US election, and therefore there is some deferral going on in terms of investment expenditure. But basically people can't see the fundamental demand. They've got plenty of money and they will invest the money when they're confident about the demand story. I don't think it's so much the purely political side of it. I think it's just their belief at where they are in the cycle, and their willingness to invest in obviously new plant and equipment and new factories and so forth. But we've got a number of businesses that are rapidly spending money in this environment. If you look at Google and eBay and other businesses, they're not holding back for 1 second about what's going on. At the moment, you've got other businesses like Coca-Cola with the global business and Yum Brands. They're not missing a heartbeat with what's going on, and they're very, very upbeat. Sure, they think things could be slow in the next 6 or 12 months, but most of these companies are very long-term focused, and there's nothing on their horizon. You know, things have slowed down a little bit in the last 6 months for what's going on in Europe and the US political situation and China. There's no doubting that, but many of these companies aren't unlike what they did in 2008, where they fundamentally hit the brakes on everything. These companies aren't doing things materially differently in the last 6 months that they've been doing in the last few years in terms of their expenditure plans. This is going to be right, that the markets are just enough. You know, the markets have gone up 10% since he went to cash.
Yeah, Hamish, just a question on the US trajectory out of this mess. It would seem to me that, you know, with the amount that was borrowed over a very long period of time by US consumers, that it's going to take a long, long time for this to work through the system. And if we do actually get a normalisation of interest rates, longer term interest rates, as you're suggesting, consumers really so far have maybe adjusted 30 to 40% of the amount of money that was borrowed when this whole thing started back in 1995. So there's still a long way to go. Don't you see that as a reasonable risk for a lower growth trajectory out of here, as well as the position the US government's going to be in terms of debt?
Yeah, I think it's a very good observation. Look, at the end of the day, the growth up to 2006 around the world was exaggerated because credit growth was growing at a far faster rate than income growth, and people were gearing up relative to their income generating capacity. That happened in Australia, it happened in the US, it was happening everywhere. So some of these economies were actually growing at above trend growth rates because of an excess of credit growth in their economies. So I'm not espousing that the US is going to go back to that rate of economic growth as its long-term outlook. What I do believe is a situation, the US consumer has actually not back down to where it was 1995, but has materially deleveraged from where it was in 2007, a lot because quite a lot of the mortgages have been written off. So the debt has just been vaporised in the consumer sectors, but the cash savings rates went up across the economy, as is happening in this economy at the moment, and therefore the consumer is less leveraged than it was. What I think is going to happen over the next 3 years, we're going to muddle along for maybe the next 18 months, but positive in the US. Housing's going to lead them out. We'll get a more typical trajectory out of a recession. It will just happen to be 7 years into this scenario. Then we'll come out, and the plateau that they will land on will be a lower growth plateau than when we had the very high growth because of the expansion of credit. So I would agree with you, but I don't think we end up in sort of a Japan deflationary loop in the United States. I think there's a very low likelihood of that happening.
Over there.
Sticking to your central thesis around the United States, the path you're suggesting would seem to lead to growing profits of US and indeed, you know, multinational corporations. Yet all the analysis I see suggests that profit share of US-based corporations are at a 60-year high. So is the best behind us, or is this just going to continue and there's no reversion to the mean on profits?
Yeah, I've read a lot of the analysis from Grantham and others about the revision to the mean on corporate profitability and margins, the percentage of national income in the United States, and particularly where that analysis has been done. I personally think it's a load of baloney at the end of the day, because you can't compare the US economy 60 years ago to what it is today. These multinationals have developed businesses globally around the world. Many of those businesses, when they were being developed, were losing money. They're in businesses that are rapidly gaining scale in Brazil and China and India, and they're currently low margin, and their margins are expanding in the S&P 500, is all these offshore earnings are actually becoming more and more profitable. And the analysis people do that somehow ignoring the fact of these immensely large businesses that these companies are getting scaled to outside of America and multinationals. And secondly, what's happened over that period, and it's happened in this economy, is that industries have rapidly consolidated over 50 years, and it's much harder for competitive forces to have the same impact on margins. And I'll just ask you a question is, whilst credit growth has slowed dramatically, and of course we could have a recession in this country, who thinks margins of the big four banks in this country are going to rapidly deteriorate to some historical mean of 50 years ago? They control 80% of the industry now, and that's what's happening. Global consolidation and globalisation has actually changed the profit paradigm of these immensely large multinationals. Of course, in more fragmented industries that are domestic in the United States, that are intensely competitive, and retailing would be one of them, yes, you get revision to the mean. But I think it's very hard to make that statement in aggregate, and I would have a very high wager with you that Coca-Cola's margins are not going to revert to the mean over the next 20 years.
Sorry, Hamish, just following on from my earlier question, one of the things I was interested in terms of management strategy is the unemployment rate in the US. And we all know, 70% of the US GDP is its own consumer. We know that 50% of corporate profits globally are still derived in the US. So is it a chicken and egg scenario, or will companies start hiring again before they see growth, or do we need to see growth, and where will that come from for companies to start hiring? I mean, unemployment is a massive sticking point there, and seems to be this path you talk about where the housing market turns and then the US takes 7 years to recover. I mean, that's a huge drag on their economy, isn't it?
Many parts of the US economy that really have healed a lot. The part that hasn't healed is really the housing construction sector, and it's massive in the scheme of the economy. We have never seen a depression in housing construction in any other recession in 60 years has gone in anywhere close to what's happened in the United States in terms of housing starts. And when housing starts come back, you have to think of the multiplier effect. There'll be $400 billion being spent more on housing. That will be employing all the contractors. Of course, it'll be employing all the, which largely domestic industries, the paint manufacturers and the gypsum board manufacturers and lumber and you name it in the United States. When those people all get jobs, they will then start going to buy the car again. They will go out to a restaurant again. They'll go to the shopping malls. Those people will then start putting on jobs, and you get the multiplier effect. And we have a view that when housing comes back to 1.3 to 1.4 million housing starts, you're going to see an unemployment rate in the fives again in the United States. And so, you're not going to get, not boom times, but, I think it's a very probable outcome. The US is a highly dynamic economy.
Out the back, Hamish.
G'day, Hamish. In the previous question, you made reference to the four big banks in Australia and the sort of concentrated market. And earlier on, you talked about that you tend to switch out of more expensive stocks, those that you believe have are fully valued or thereabouts. One could argue that what if those fully valued stocks actually have fundamental earnings year on year that actually support their valuations? And an example of that domestically is the Commonwealth Bank, where despite contracting loan market and everything else, year on year they produce profit growth, earnings growth, and obviously dividend stability as well. So what's your view in terms of the opportunity cost for switching out of those stocks when you have the fundamentals from an earnings perspective supporting those valuations?
Well,
obviously the global, yeah.
This is actually a wonderful question because it's been framed in terms of the opportunity cost is exactly how we think about that equation. And some of the things we have switched out are not overvalued. Okay, they are not overvalued where we have switched out of those opportunities. We're not really in that market environment where things are massively overvalued, even in defensives. What we measure is, we effectively, we measure this, we run this portfolio like a football team. And every single stock has a position on the paddock and it has to do something, and we've effectively got 25 players that I can run in this football team, and in order to win the grand final, we have to switch those players out on the basis of an opportunity cost. I could keep the Commonwealth banks in the portfolio because they're not overvalued, but I would then have 27, 30, 35, 40. I'd keep buying more and more. Coca-Cola, I've sold L'Oreal, for instance. It's not overvalued, but the opportunity cost was I could find something with similar risk characteristics with better return prospects than L'Oreal was priced at the time, so we sold it and put another player playing their similar position in the portfolio with a better return and risk outcome. So it's very much the opportunity cost. We're not necessarily selling things because we think they're necessarily overvalued. Sometimes we may do that, but we're typically trading them out for opportunity cost reasons. We can find a better player to put on our team to play in that position that we want it to play in.
Just there.
It's Peter Hector. Question I wanted to ask you was about the recession that you're predicting in Europe, which is going to go on for a long time, is causing an awful lot of pain now and is going to cause even more pain. How confident are you that the politicians in Europe are able to handle all this pain on the ground?
Yeah, it's a very good question. I think they're going to have to be very careful, particularly where the pain is immense, and the pain is immense in Greece at the moment. There is a depression to this, and there is an immense human cost to what's happening, and Spain's in a very similar position. Unless there is a ray of hope, you could either get very radical elements developing within some of these economies, or you could get a lot of social destabilisation. So I think that's one of the bigger risks of seeing this through, and where Germany needs to be careful in how it plays the game, is could it have a social dislocation effect within Europe, and we all know Europe's history here because of the immense austerity pain that people are going through. Will the politicians and policymakers be able to keep a balance that heads off that risk? I would hope so, but it's a very genuine risk and a very worrying risk within Europe, and I guess it's one of the black swan type events that you get a much worse outcome from a social point of view and a political point of view in Europe developing. And it's happened in the past in Europe's history, as we all know.
Where's Jack? Just here.
Dion Pickage, New Wealth, Hamish. Hamish, I've been waiting for it and waiting, but you haven't said it. In terms of the mandate, are you still targeting businesses where more than 30% of the sales revenue is coming from the developing world?
Well, we have a part of our portfolio in the consumers. We're very attracted to multinational consumer franchises that have leading market positions in the developed world. The overall portfolio has about 21% of its earnings directly coming out of the developing world at the moment through the ownership of businesses like Yum Brands and Coca-Cola's and McDonald's and you name it. So we've got about 21%. We were slightly higher. Some of that plays become more expensive, but when it's not more expensive, we will be there again. We like it because it gives us a greater degree of confidence above the top line revenue story for that grouping of companies looking at. It's still a very important element. It's less important because it's become less expensive. It's become more expensive in the last 6 to 8 months, but it's still a very important thing. We like that theme a lot, but we're not going to own it unless we can get the returns we want.
All right.
Hamish, can you? Sorry.
Thank you. And the other thing that I wanted to ask you about, you touched on it earlier when one of the other gentlemen asked you the question about Australia, and you snuck in a little bit of a pearl about expectations with Australian market. So I just thought, would you elaborate on that? Are we all going down the toilet here in Australia, or is it, or are we going to see some, or are we going to see 6,000 or 6,000 plus again?
I'll answer in two parts to that question. The first one, quite a lot of people ask, which is sort of your 6,000 question, is the Australian market hasn't gone anywhere practically in other markets like the US, S&P 500's rebounded. shouldn't we be going back to the Australian market? It must be its turn. Australia must be undervalued. And what I would say to you is the markets are being entirely rational about how it's pricing Australia and how it's pricing something like the S&P 500. We have to understand that Australia is 65% in resource stocks and major financials stocks. The top line growth in banking financials has all but disappeared for the next period of time. It's not a disaster, but the top line growth has gone out. Therefore, the excess returns in financials, I don't think the big banks are a bad place to be on by way of the Commonwealth Bank, but the rate of revenue growth is going to mean lower returns than we've seen in the last decade or so. And I think we're past the point of inflection. I gave a speech 2 years ago when I thought peak commodity demand was going to hit, or peak steel demand was going to hit China, and I said 2015. I'm probably gaining in confidence around that prediction. And therefore, I think the market is factoring into Australian aggregate stock prices the outlook for the big components of our market. So I don't think the Australian market is being irrational in the pricing of the index. I don't think it's dramatically overvalued. I don't think it's dramatically undervalued for what's going on in the world. Then why has the US market gone up? Because the US has a much higher probability of actually in a 3-year having a more positive scenario from a US recovery. The Australian economy isn't coming out of a recession. It's still peaking near its peak at the moment, and if anything, the picture out a few years is less positive in Australia than it is today. When the US, looking out a few years, is more positive than it is today, not negative. And so stock markets anticipate these things. The US stock market has been stronger, the Australian stock market has been weaker. But when the opposite was true, when China was on fire and credit expansion was on fire, the Australian stock market materially outperformed, and that was rational as well. So I'm not trying to paint an overly negative picture. I just say is understand what drives our Australian stock market. It's our resource sector, and it's predominantly our banks, and we're in a different part of the cycle, and we're in a different part of the cycle where the US economy is at the moment, and there will be points in the future where it will be better being in the resource story than it would be being in the US economic story. I just don't think that we're in that particular zone, and I think the markets are being largely rational in what they've done and what they're pricing, what the most likely outcomes are for both Australia and the US in the next 3 years or so.
I'm just conscious of time. Hamish, other tailwinds within the portfolio? Like we've touched on emerging market, we've touched on the US recovery. Anything else that you think is going to do well in the future?
Yeah, well, we've obviously got some very specific plays around Novartis and Tesco and others where some things have happened and we've seen opportunistically some very interesting single stock ideas. In terms of sort of themes, we're still very big on this, and Dom Giuliano's here, and we've got Chris Webster who covers our tech space. The whole payment space is something that is highly attractive to us, and eBay has been a very big position pretty much through the whole play. You can see it's our largest position, nearly 7% of the fund. They own a business called PayPal, and they own eBay. That company is on fire at the moment, and the PayPal business has the potential. It's a probability, but it has the potential. PayPal of itself has the next potential to be Apple or Microsoft. It's of that scale, and we're in a very early innings of that, and we like the payment space, and you can see we own Visa and American Express, and we own MasterCard in this transition out of cash into a cashless society. It's interesting, there's been quite a lot of commentary on this move to a cashless society, even in our financial press in the last 6 to 12 months. We've been on this topic for a long time, and it's still got a very long way to run.
Final question or two. US gas was the question?
Yeah, US gas, and how I would connect that, we obviously don't do energy and commodities, but there is a shale gas revolution that's happening in the United States, and fundamentally changing, I think, the trade account for the United States looking out. Not are they onshoring jobs for other reasons at the moment, but their dependence upon foreign oil may fundamentally change with the shale gas revolution. It doesn't mean it would be a fun thing to own investments in shale gas. If a lot of capacity goes in, there may not be a lot of economic returns, as BHP may be finding out. But it is the whole nation is connected by a very sophisticated gas grid, and whole parts of their industry could be, both power and industrial industry could be powered by gas in the United States at very cheap rates, and that will dramatically reduce their dependence on foreign oil. And if you look where US military policy is being directed, it's actually been taken out of the Middle East at the moment and directed into Asia Pacific at the moment. I think that is a forward-looking view that they're becoming less dependent upon the Middle East for energy sources. So I'm very optimistic that the shale gas revolution is hopefully very positive for world geopolitical stability, but also very positive for the balance of payments, which has an implication for the US dollar at the moment.